Managing inventory is like walking a tightrope. One wrong step can send a business tumbling into chaos, or worse, financial ruin. Among the many metrics that help businesses navigate this delicate balance, one stands out: Days Inventory Outstanding, or DIO for short. Now, you might be wondering, what exactly is DIO, and why should it matter to you? Well, let's break it down in a way that's engaging, relatable, and informative. First off, let's define what Days Inventory Outstanding really means. In simple terms, DIO measures the average number of days a company takes to sell its entire inventory. Picture it this way. If you had a store filled with products, DIO tells you how many days it would take to sell everything on your shelves if you kept selling at your current rate. It's like keeping score in a game where the objective is to keep your inventory moving and your cash flowing. So, why should you care about DIO? For one, it's a crucial indicator of inventory management efficiency. A high DIO can signal that a business is sitting on too much inventory, tying up capital that could be put to better use. Imagine having a garage full of stuff you never use. It's cluttered and you can't park your car. Conversely, a low DIO might indicate that a company is running the risk of stockouts, potentially losing sales and disappointing customers. Finding that sweet spot is essential for maintaining healthy cash flow and profitability. Now, let's talk about how to calculate DIO. It's not as complicated as it sounds. The formula is straightforward. You take the average inventory value and divide it by the cost of goods sold per day. Then multiply by the number of days in your measurement period. To put it simply, it's like calculating how many days of groceries you have left in your fridge based on what you typically eat. For instance, let's say your average inventory is $500,000 and your annual cost of goods sold is $2,000. If you're measuring over a year, you do the math like this. DIO equals $500,000 divided by $2,000 multiplied by 365, which gives you about 91.25 days. This means it takes you, on average, 91 days to sell everything in your inventory. Easy, right? But now that we've got the numbers down, what do they actually mean? A high DIO can indicate a few things. Maybe your sales are sluggish, or perhaps you're carrying too much stock. It's like having a closet full of clothes, but feeling like you have nothing to wear. On the flip side, a low DIO can be a sign of efficient inventory management, but it's essential to ensure that it doesn't lead to stockouts, which can frustrate customers and hurt your reputation. Understanding DIO also allows businesses to identify trends and forecast demand. By comparing your DIO against industry benchmarks or your historical data, you can spot potential issues before they become significant problems. It's like keeping an eye on the weather. If you see storm clouds gathering, you'll want to grab an umbrella before you get soaked. Now, let's dive into some of the common challenges businesses face when managing DIO. One of the biggest hurdles is ensuring that the data used to calculate DIO is accurate. If your data is off, your DIO will be too. Imagine trying to bake a cake with spoiled ingredients. It's not going to turn out well. Time constraints are another challenge. For businesses with large inventories, calculating DIO can be time-consuming, making it tough to stay on top of inventory levels. And then there's demand forecasting, which can be a bit of a crystal ball exercise. Predicting customer behavior is notoriously tricky, and any fluctuations can lead to overstocking or stockouts, both of which can negatively affect DIO. Supply chain issues can also throw a wrench into the works. Delays or quality problems with suppliers can lead to excess inventory or stockouts, impacting DIO and, ultimately, profitability. And let's not forget about cost management. Finding the right balance between carrying enough inventory to meet demand without incurring excessive holding costs can feel like a juggling act. So, how can businesses reduce and monitor their DIO effectively? One popular strategy is implementing just-in-time inventory management. This approach means ordering inventory just in time for production or sale, reducing excess stock. Think of it like only buying groceries as you need them rather than stocking up for a year. It can free up cash and minimize carrying costs. Another effective strategy is demand forecasting. By analyzing historical sales data and market trends, businesses can predict future demand more accurately. This helps avoid the pitfalls of overstocking or understocking. It's like planning a party. You want to make sure you have enough food and drinks without going overboard. Optimizing inventory reorder points is another crucial tactic. This means determining the right inventory level at which to reorder to avoid stockouts while minimizing excess stock. It's about finding that sweet spot where you're prepared for demand without drowning in inventory. Building strong relationships with suppliers can also make a significant difference. When you have reliable suppliers who understand your needs, you can reduce lead times and ensure timely deliveries. It's like having a trusted friend who always brings snacks to the party. No one wants to run out. Utilizing inventory management software can provide real-time visibility into inventory levels and sales data. This technology can automate many processes, making it easier to track inventory, manage orders, and forecast demand. It's like having a personal assistant who keeps everything organized for you. Lastly, implementing ABC analysis can help businesses prioritize their inventory management efforts. By categorizing items based on their value and importance, companies can focus on the products that significantly impact profitability, while managing lower-value items more efficiently. Now, let's talk about how DIO impacts working capital. Working capital is the lifeblood of any business. It's the cash available to fund day-to-day operations. Since inventory is often a significant component of current assets, reducing DIO can free up cash for other investments or expenses. A high DIO means a business is holding onto a lot of inventory, tying up cash that could be better utilized elsewhere. It's like having your money stuck in a savings account instead of being invested in growth opportunities. On the other hand, a low DIO can indicate that a business is effectively managing its inventory, allowing for more cash flow to invest in growth, pay down debt, or improve profitability. It's like having a well-oiled machine that runs smoothly, generating cash and allowing you to seize new opportunities. Let's take a look at some real-world examples of companies that have successfully managed their DIO. Toyota, for instance, is a pioneer of just-in-time inventory management. By working closely with suppliers and implementing a pull-based production system, they've maintained low DIO levels, minimizing waste and improving efficiency. It's a testament to how effective supply chain management can lead to success. Walmart is another great example. Known for its advanced inventory management practices, Walmart uses demand forecasting and cross-docking to keep its inventory moving. By anticipating customer demand and minimizing storage time, they maintain low DIO levels and keep their shelves stocked with the right products at the right time. Apple also excels in managing its DIO by leveraging accurate demand forecasting and strong supplier relationships. Their ability to respond quickly to changes in demand while maintaining low inventory levels is a key factor in their success. It's a prime example of how effective inventory management can drive profitability. Finally, it's essential to recognize that DIO benchmarks can vary significantly across different industries. For instance, retail businesses might have a DIO ranging from 50 to 100 days, while manufacturing industries may see a DIO of 20 to 90 days, depending on the type of products they produce. Understanding these industry-specific benchmarks is crucial for evaluating a company's performance. In conclusion, understanding and managing days inventory. Outstanding is vital for any business looking to optimize its inventory management practices. It's about finding the right balance between having enough inventory to meet demand without tying up too much working capital. By calculating DIO, interpreting the results, and implementing effective strategies to reduce it, businesses can improve their financial health, enhance cash flow, and ultimately drive higher profitability. So, the next time you think about inventory, remember DIO. It's not just a number, It's a reflection of how well a business is managing its resources and positioning itself for success. Whether you're a seasoned entrepreneur or just starting, mastering DIO can lead to a more efficient, profitable, and sustainable business.